Hi, in this video we are talking about a simple life insurance strategy that small and medium company owners can use. It's called laddering your term insurance. This helps to optimize your premium outflow against the amount of effective coverage that you get to protect your company and the amount of time, the time period that you get the protection for. I want to give you a disclaimer that you should not consider this case study as a financial advice. Instead, consult a financial advisor, have a proper plan, and plan your life insurances based on your individual circumstances, because it can vary from person to person and company to company. Coming to the video, we are talking about how to ladder your life insurance to optimize your premium. So, to put it simply, it's about using multiple term insurances to achieve the coverage amount that you require. For example, in this case study, we're talking about a business owner who has started a small or medium company and wants to scale it up. He is in the process of scaling the company, and he also has a family here. Kids are going to school or early years of college. The person is in his 40s and he's located in Dubai. Now, his CFO has advised him to go for a $10 million coverage, because at this stage, the company is going to take on more loans and credits from the banks. To take up bigger, profitable, and prestigious projects, he is going to take goods from suppliers on credit, and a lot of things. All the risks that you can think about concerning your company, you can bring it onto your mind right now. So the CFO says go for a $10 million coverage, and his financial advisor immediately conforms to it after assessing his situation. Now, the premium for a straight 30-year term policies looking exorbitant for a straight 30 or 10-year coverage. I'm also assuming the business owner is fit and healthy. So what you can alternatively do is, after careful assessment, you can ladder your $10 million coverage onto multiple policies. In our example, I'm just going to take 3 policies. 1, 2, 3. 3 different term insurance policies which covers you for different time periods in time. The first policy is going to cover for 10-year period. The second policy is going to cover for 20-year period. And the last policy covers for the longest time, which is for 30 years. And the life insurance amount on each policy is also different. So we want to achieve a net effective cover in the first 10 years, which I'm assuming right now that the company is taking on the highest risk while the company is scaling up. So we need to achieve a 10 million in the first 10 years and not everything on the 30-year policy. Now let's do a little distribution. I'm putting 20% of the 10 million on the 10-year policy. So that's a $2 million cover on the 10-year policy, which means 10th year this policy expires, which is fine. The CFO also agrees to that. The company might not have so much risk as assumed today after 10 years. So expected to be more financially stable and more assets to back up and self-insure the company. The second policy, I'm going to put a $3 million cover. 3 million for 20 years, which expires in the 20 year. That's okay. Now 2 million and a 3 million has fallen off the book. That's fine, because the company is getting more and more stable and the requirement for life insurance should ideally reduce over time. And the third policy, the balance of to reach the $10 million is $5 million. which stays for an entire 30-year period. And we can assume my client here is now already 70 years. So for anything that coverage that you need beyond 70 years of age or 30 or 35 years of term period for the insurance, you need to explore a permanent insurance option. That's a different topic of discussion altogether. So this is how you ladder your term insurance, and this is surrounding a principle of life insurance that the longer the period, the insurance company is going to assume that the chances of somebody claiming from the policy is much higher the longer the period, and shorter the period and the chances of claiming from the policy is reducing. So as the chances of claiming reduces for a shorter period policy, the premium is much lower for the first policy, a little higher for the second policy, and you can assume the full premium to be paid for the third policy, and the average works out to be much lower. This satisfies your actual requirement. This way your premiums are optimized and you achieve your effective coverage. Your family is safe. You reduce your dependence on the insurance and credits as you go. You're not paying more than needed to life insurance companies. If you found this video useful, please give me a like and comment your thoughts on the comment section below. Also share it with business owners who you care about. I'll make it sure that I come back to you with more informative video to help you safeguard your business and family here in UAE.